In simple words, accounting could be defined as the process of recording, summarizing, analyzing, and reporting financial information pertaining to any business. Although it seems like the brainchild of contemporary financial setting, the earliest attempts of accounting date back to the ancient civilizations. And this very fact highlights the importance and involvement of accounting in human life across centuries. Moreover, the significance or importance of accounting is not just limited to the technicalities of running a business. Its essence permeates through our day to day lives and composes a variety of ordinary activities like filling our income tax returns or even making a monthly budget. Since these tasks could prove to be quite tedious more often than not, I am here to beat your struggle by introducing you to some basic terms used in accounting, a few essential concepts as well as particulars related to financial statements and the accounting cycle. So just sit back and watch your ordinary accounting troubles fade away. If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of great learning. And of course, if you enjoy this video, show us some love. Do like the video. Knowledge increases by sharing, so make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions, and I would be more than happy to respond to all of your comments. Before moving on, let's look at some of our learning objectives. So we'll start by knowing what is accounting, what is the need of accounting, and also what is the use of accounting. Then we'll know the importance of a term called bookkeeping in accounting. Furthermore, we'll be knowing basic terms and terminologies that are used in the accounting world. And also we'll know some of the ways in which we can record transactions. Then we'll know how we can track those financial transactions either from B2B, business to business, individual to business, and so on. Then we'll be knowing how these transactions are converted with the help of accounting to three financial statements: balance sheet, income statement, and cash flow statements. Then we'll know some of the basic accounting concepts that are a must to know when we are learning accounting. Then at the end, we'll walk you through the various phases of an accounting cycle. Let's start off by knowing what is accounting. So, the first thought that comes to our mind when we hear the word accounting is something related to money and certain transactions involved, right? So, the way of recording financial transactions related to an individual or business is called accounting. So, it is basically logging certain expenses that have been incurred or revenue that has been generated. So now it involves accounting process involves three major phases. The first one is recording, second is reporting, and the third one is analyzing those transactions for various stakeholders and regulators involved. So it can be internal stakeholders like the board of directors or external stakeholders like general public who wants to invest their money in the company, or regulators like SEBI, Securities and Exchange Board of India, or Tax Department. They would want to know that what are the financial transactions happening in your company. Now, second question that comes to our mind is what is the need of accounting? Now, for an individual, it could be knowing about the certain expenses they have incurred over the past month or the past year, and also in what all categories their expense was. Was it in food, travel, shopping, etc.? Also, for a business, it could be knowing what are the best selling products of the company or how much cost they have incurred while producing those products. Also, they would want to know how much budget they spent in, let's say, marketing. So, for all these questions, we would need a certain set of rules and procedures in which different numbers are set up. So, this way in which all these numbers are summarized together is called accounting. And also, the third question that comes to mind is what are the benefits of accounting? Now, accounting would be used to develop a more efficient way of utilizing the money, which is also called cost control, and also to make very well informed decisions and thoughtful decisions for the company's future. You will also gain an understanding of how your competitors are doing by seeing those financial statements or accounting statements. Therefore, it becomes really important to learn accounting so that we can grow our business exponentially. Next, we'll talk about the types of accounting. Now, there are primarily five types of accounting. So, we'll go through each one of them one by one. The first one is financial accounting. Now, financial accounting deals with the summarization and recording of various transactions into building three major statements. The first one is balance sheet, second is income statement, and the third one is cash flow statement. Now, these statements are readily available in public domain because it is both for the internal stakeholders and external stakeholders of the company. Next is management accounting. Now, this deals in identification, analysis, measurement, and interpretation of money related transactions. The point to be noted here is that management accounting is only for the internal top management of the company, and no information is available outside the company. The third type of accounting is tax accounting. Now, tax accounting involves the calculation of various taxes that the corporate has to give. Now, this type of accounting deals in the tax payments and tax returns of a company. So, it involves maintenance of GST records, paying of corporate taxes, etc. And also, this type of accounting is very important for individuals like you and me. So it involves filling of income tax returns, declaration of your investments, whether you have any capital gains involved or not. The next type of accounting is credit accounting. Now, credit accounting deals in the liability section of the company. Now, liabilities can be any. It can be a loan from a company, a loan from an individual, an organization outside the company, or even the mortgage that the company is bearing. Now, these type of liabilities have to be accounted and it comes under credit accounting. The last type of accounting is cost accounting. Now, cost accounting is a subset of management accounting, which deals primarily in the cost side of the company. So, the cost can be cost of production, cost of operation, and other miscellaneous variable costs. Next, we move on to bookkeeping. Now, bookkeeping is a very common term used in the accounting world. It is a systematically noting down of various transactions that are happening in a company on a day-to-day basis. Let me explain you this with an example. Let's say that you are an owner of a phone manufacturing company and would want to know what are the total profits that are earned. Now, in order to know the profits, you need to know what are the costs that has been incurred in making that particular phone. So let's run through the steps of it. The first would be design. The design team would design a particular phone. Then there would be material cost like the cost of casing, the cost of screen, the cost of various sensors and cameras, and also certain things would be procured by third party vendors like let's say chipset or batteries. So these all would be the primary cost of a phone. On the top of it would be secondary costs like electricity bills, supply chain and logistic cost, and various other costs. So after this, you would be marketing the product. Then you would incur a marketing cost and then you would sell the product. Now, the revenue that would be generated after selling the product minus your cost incurred would give you the profit remaining. Now, all these costs have to be noted down step by step in a systematic manner so that later you could go back and see what are the costs that were incurred. Now, the process of systematically noting down is bookkeeping. Now, what are the benefits of bookkeeping? So, bookkeeping provides an accurate picture of how well the company is doing, whether the company is in profit or is in loss. That would be understood when we do bookkeeping. Next would be it helps detect any fraud or irregularities in the transaction. So there can be times when certain things have been missed by a memory. So we can find what that is. We can detect frauds. We can detect what are the errors in certain transactions. The third one would be tracking inflows and outflows. So it means what are the cash that has come in from selling the product and what are the costs that were involved in making that particular product. So how much cash is available and how much cash has gone out of the company. Now, bookkeeping in itself is a long and a tedious task to do. And to make sure everything goes perfectly in the most efficient manner, this is divided into two sections. One is record keeping system and the second one is tracking the transactions. Now, in order to make that system, there should be some terms and terminologies that are commonly known to everyone, like revenue, assets, and so on. So we'll know about that in the coming videos. And the second part is to track these transactions. Now, the transactions can be a lot of different types. It can be complex transactions. It can be a very straightforward, a one-on-one exchange of money transaction. So to know all those transactions, you need to know what are the types of basically tracking those transactions. So we'll know that coming forward. So let's get started. The first phase that we'll be talking about is record keeping system. Now, before moving on, let me ask you this question. Can a profit of a company be greater than its revenue? We'll find the answer of it at the end of this module. So first off, record keeping system. So in order to develop any system, there should be some common terms and terminologies that should be widely accepted. For example, the head of a governing body of the country would be the prime minister, while the head of any government of a state would be chief minister. Now, these both terms are commonly accepted, and both you and I know what they are. Now, similarly, in the accounting world, we have some terms and terminologies that are commonly accepted, like revenue, liability, asset, expense, equity. So we'll know each one of them going forward. The first one is revenue. Now, the amount generated by the company from its core operations by selling a product or a service in a given period of time is called a revenue. Now, let's say that you are selling samosas. So each samosa is of 20 rupees. Now, 20 rupees, the selling price would be your revenue, right? So the point to be noted here is that the revenue is not equals to profit or loss of a company. It is just the selling price of the company. Okay. Next up, we'll know about expense. Expense is the total cost incurred by the development of a particular product or service. An expense does not have any future benefits. The example of expense would be rent, electricity, your telephone bills, etc. Now let's take an example. Say that you are selling a cup of tea. So your one cup of tea would be sold for 10 rupees. Okay, 10 rupees. Now this 10 rupees is your revenue. You would also have certain expense in it. Like to make a cup of tea, you would need what? Sugar. Let's say in a cup of tea, it is rupees 2. You would need tea leaves. That would be rupees 3. And milk would be, let's say, 1 rupee. So now these three sections, 3, 4, 5, 6, your 6 rupees would be your expense. Now, if I subtract my revenue out of the cost that I have incurred, I'll get rupees 4. That is my profit or net income. Now, if I say, can the net income be negative? The answer is yes. So for example, your revenue is rupees 20 and expense is more than that, 30, then you would have a net income of minus 10. That would be your loss. Next is assets. Now, asset is something that has a future economic benefit to the company. So it can be cash, real estate, investments, machinery, patents, office equipments, vehicles, etc. Now, assets can be divided into two parts. Number one being current assets. Current assets. And the second one is non-current assets. Now, current assets would be something that have an economic benefit within an year. So this is short term. So it would be short term investments or short term account receivables, etc. Whereas non-current assets would be something which drive an economic value after a year. So these are long-term investments, or investments in land, investments in equipments, investments in vehicles, etc. Assets can also be distinguished into two other types. Let me show you. It can be distinguished between tangible and intangible assets. So tangible would be something that is physically present, what you can touch or feel, like land, equipments, factories, vehicles, etc. While intangible would be something that we cannot see or touch. That would be patents, copyrights, or even trademarks. These all come in the category of assets. Now let's talk about liabilities. A liability is something that the company has borrowed either from an individual or an organization. So the example would be bank debt, mortgage, money owed to suppliers, tax owed to the government, or even wages that is due to be paid. Now, the liability can also be divided into two parts: short term liability and long term liability. Short term liability would be short term loans, long term liability would be long outstanding loans or mortgages. So these are the examples of liability. Next is equity. Now, equity is the amount of capital that is invested by the promoter of the company. Equity is basically, in layman's terms, the ownership of a company or a thing. Let's take an example. Let's say that you as an individual is buying a car. So the car cost 1 crore. Okay. And you have 20 lakhs in hand with you. And the rest 80 lakhs you take a loan from a bank. Now this would, the 20 lakhs that you have in hand is your equity, and the 80 lakh is your liability. And this car that you bought is your asset. Okay. So basically you have 20% of ownership, which holds true this equation: equity equal to assets minus liability. Equity, that is 20 lakhs, equal to 1 crore asset equity minus 20 lakh, 80 lakh of liability. The next module is tracking transactions. So in the previous module, we already learned some of the basic terms and terminologies that are used in accounting, be it revenue, asset, liabilities, equity, expenses, etc. So now in this module, we'll know what are the different ways in which we can know that a transaction is occurring, right? So what is the second question that comes to our brain is, what is the need of tracking transactions? So let's say that you are living on rent and you have paid a security deposit to your owner in cash. So at the end of the tenure, you demand your security deposit back, but the owner refuses to give it, stating that you have no proof that you paid that amount. Now, in this case, what would you do? You have no proof of the transaction. You have no proof that you paid the owner the specified amount. In these cases, it becomes essentially important to have a proof of those transactions. So it can be an invoice, it can be a receipt that is being generated, a bill, we can say. So these are the things that are a must to have when it comes to noting down these transactions in the account books. Now, the first step in the process is knowing that if there is a sale occurring. So what is a sale? A sale is a negotiation between two different parties in which there is an exchange of money with goods or service. So one side should sell a good or a service, it should provide a service. The other side should pay the amount or the money to it. In the earlier times, it used to happen that there would be no exchange of money, but it would be a barter system in which you could give a material or a good, or you can receive a good or a service. But now in this era, you have to give money to avail any goods or service. So that is the first step in tracking our transaction, that a sale should happen. Now, in order to know that a sale is happening, you should either have a receipt to it. Now, what is a receipt? So the receipt is an acknowledgement document that the seller has received the payment by the buyer. Okay, so the example that I gave you, when you are on rent and you're paying your rent, that the owner will give you a document stating that the amount is paid. So that is a financial transaction that is called a receipt. Next up is invoice. Now, invoice is the piece of paper that is given to the buyer by the seller to collect payment. So basically, the difference between invoice and receipt is that in invoice, the payment has not been made, and it is invoice is requesting you to pay that amount. While in receipt, the amount has already been paid and you are getting an acknowledgement of it. Now, the invoice are mostly popular between business to business transactions, as they have a lot of transactions in bulk that are due to be paid in the coming months ahead. So that's why it is mostly popular in business to business transactions. Now, another thing is both the receipt and invoice have a lot of things in common, like the order date and the order number would be mentioned in the invoice or the receipt. The description of the amounts that have been sold or bought would be listed there. If there is any tax deductions, it would be mentioned. If there is any discount or a coupon that is applied, it would also be mentioned. Apart from it, it would also have the seller's address and the buyer's address as well. So the last type of transaction that we are looking at is employee compensation or payments. Now, this is very internal to an organization, in which as a owner of the company or as a board of director, you would look at what is the total amount that is being paid to the workers, to your employees, and also what are the total reductions are happening. So what type of reductions we are talking about? TDS reductions, that is tax reduction at source. And also, since like it is pandemic going on and everyone is working from home, so the internet reimbursements that are happening, that also are needed to be accounted for. So all the transactions are to be noted down in account books. So after the bookkeeping phase comes the third element of the accounting process, called reporting transactions. Now, these transactions can be reported by making three financial statements known as the balance sheet, the income statement, and the cash flow statement. Now, just like you and I used to have our report cards during college and school days, similarly for a company, these financial statements act as a report card so that we can analyze how fundamentally strong the company is. We can also know what are the assets, liabilities, what is the expense and revenue of the company, and also what is the equity of the owners in it. So all these informations can be extracted from these three financial statements. Now let's look at the first statement, balance sheet. So balance sheet is the information about the assets, liabilities, and equity of the company. We have already discussed these three terms before, so we'll know where they are placed in a balance sheet. Before moving on, there is a term called an accounting equation. So we'll know what that is. So accounting equation states that an asset is equals to liabilities plus the equity. Now, what does this mean? So this means that the assets that the company owns is equal to the liabilities, or what the company owes to its lenders, plus the equity of the owner or the promoter of the company. Okay, so this is called an accounting equation. So this thing is really important point to be noted, that asset equal to liabilities plus equity. Now we look at a balance sheet of a FMCG company. So here we have the balance sheet. Okay, before moving on, let me tell you where can you find these balance sheets. So if you go to any company's website, be it Reliance, Adani, or any other company, you can go to their website. So there would be a section called as shareholder information. So you click on that, then you will have a PDF document of annual report. So you click on that, and in that annual report, you will find all these three statements: balance sheet, income statement, and cash flow statement. So now in this case, this is a balance sheet of a FMCG company. This is a balance sheet. Now, as mentioned before, it has three major sections: asset, liabilities, and equity. So we'll know what that is. So the first part here we can see is the asset heading, right? So this part until here is the asset section. Then comes the equity and liability section. So this is the equity section. Okay, wait. This is the equity section. And from here to here is the liability section. Now, assets, as discussed before, has two parts: non-current assets and current assets. Non-current are the long-term assets, and the current assets are the short-term assets. Now here we can see the different categories like PPE, property, plant and equipment. So it has an asset value of 20,650 in 2020, and the other side it is also given for 2019. Now why does the company make a 2020 balance sheet include a 2019 balance sheet figures? Right, this is because if you are a shareholder of the company, then you would want to know what are the changes from the previous years to this year. So that is why they include a section for previous year's figures as well. So now we look at what are the different sections. It has a work in process category, then the assets, the loans. Now why is that the loan is considered in an asset? So this is the value of the loan that is given to us. So we'll make a good use of it in the future. That is why it is considered in the asset section. Later we'll see it will also be provided in the liability section. Then we have other financial assets, deferred tax. Now these are a very minute things that are also included. The details of this would be in the annual reports under the sections as mentioned in the note section here. So this is the number. So if you look at its annual report, it would have these sections under which the details of the particular thing will be told in detail. Okay, so as we can see, there are some short-term inventories, short-term financial assets that have to be paid before or within a year, right? So these are the current assets. Now, the total asset here is mentioned as 1,61,704 lakh rupees. So this figure is in lakhs, so it is mentioned as 1,61,704 lakh rupees. Now in the second section, we have the equity part of it. So this is the share capital and the shareholders equity capital. So these things are also a part of the balance sheet as mentioned. So we'll look at three figures totally in total equity, total assets. Now comes to the liability sections. Now liability has again long-term liabilities that are non-current. So it would be financial liabilities and other financial liabilities for which the total description would be given in the annual report. Other than that, they have current liabilities like short-term trade contracts, micro and small enterprise contracts, and other contracts as well that needs to be paid within a year. So the total liabilities would be 70,798 lakh rupees. Okay. So now, according to the accounting equation, asset equal to liabilities plus owner's equity will. So let's see that if that holds true or not. So total assets is 1,61,704 lakh rupees, which should be equal to liabilities is 70, right? So that should be equal to 70,798 plus the equity. Total equity is 90,906. Now if I add this figure here, what do I get? 7,864,107,1,179,16. So we get the exact same figure as of assets. Now this states that our balance sheet is in balance and the assets equal to the liabilities plus equity. Hence this balance sheet is correct. So the second financial statement that we will discuss is called the income statement. Now this statement tells us about the company's revenue, expenses, and also the tax incurred on the company by the end of a financial quarter or end of financial year. Now in a nutshell, this statement provides us the information about the profitability of the company. Okay, so just like balance sheet had an accounting equation, this too has an accounting equation of its own. So in this case, it is the revenue earned by the company minus its expenses would give us the net income. Now, net income can be both. It can be either profit or loss. Okay, now let's look at an example. So here we have a profit and loss statement. So income statement is also called as a profit and loss statement. So we have this income statement from a FMCG company, fast moving consumer goods. So FMCG is basically the company that deals in the daily utilities like toothbrush, toothpaste, biscuits, and all this stuff of daily consumption. So here we have three sections. The first one is the revenue. Then there is this expense part, and lastly we have the taxation. Okay, so as mentioned, the equation revenue minus expense equal to net income should be valid. So let's look at how it is. So we'll look at the 2020 variant of it, and we can also compare it with 2019. So I'll be taking 2020 for this one. So let's look at the sections of the profit and loss statement. So the first one is the revenue. So now revenue has two parts: revenue from operations. So operations is the day-to-day activities that the company is doing. That's the primary objective. Second one is the other income. Now other income can be the investments that the company is doing in land, or it's renting out spaces, or it's investing in either, let's say, mutual funds or in different companies. So that would be the other income. Okay, the total combination of these two would be the total income. That is 3,04,610 lakhs. Okay, so then it is the expenses part of it. Now, expenses for an FMCG company, it would be the raw materials that it would buy, and also maintaining the inventories, logistic management. So all these things would account for that. Okay, apart from these three costs, there would be the salaries of the employees that need to be paid, certain financial costs like paying the rents or electricity bills and everything like that. Now, the next would be the losses. So there would be certain losses and depreciation in it. So what would be a depreciation for an FMCG company? So these are fast moving consumer goods. So they would have a shelf life or an expiry date in it. So the nearer the material would be to the expiry date, so the lesser cost they have to sell it to the wholesalers. So that would be the depreciation in it. Now, combining all the expenses, we get a total expense that is 2,45,223 lakh rupees. Okay, so if I subtract this total income from the total expense, I would get the profit before tax from operation. So let's see, 304,610. If I subtract it with 245,223. Okay, so if I subtract this, what I will get? What is this? 1, 10, 7, be 8. Then it would be 523. Then 10. Okay, 14, 4, 9. Okay, so it is 59,387. That is the exact amount we have profit from operation. So now the case would be if the expenses would be more. So if the expenses were more than the total revenue generated, then it would, the net income would be a loss. But in this case, since the revenue is greater than the expense, it is a profit, right? So this would be mentioned over here. And now we can compare. The net profit had been a little less than the previous year. Okay, so next would be the taxes. So tax would be GST. So it would be a central GST or a state GST or other small tax that are the road tax would be there, toll tax, different types of taxes for the movement of shipments. So in this case, that would also be adjusted, and then the total income tax would be 16,079 as mentioned. So if we subtract our total profit from the taxation, we'll get the exact profit after tax. Okay, that is 43,308. Now let's look at this. So our profit from operations before tax was less than the previous year, right? As you can see, but the taxation for this year is less than the previous year. So our net profit is more than the previous year. So the taxation and everything has also to be accounted in when you are looking at how the company is performing. So this would also be one criteria here. Let's look at another company in which the net income is a loss. Okay, so here we have a profit and loss statement for a airline industry, for a airline company. Now in this case we can see that you have revenue mentioned and other income mentioned. So now here it is not revenue from operations, actually it is operations only. But in case of airline, it has contracts with customers buy tickets, right? So here it is that operation income. Okay, then you have expenses. Total expenses is marked here. You subtract total income from expenses, you will get the earnings before taxation. Okay, so different taxes would be mentioned here. Then now in this case, if you actually calculate what is the total here, earnings are positive since the revenue is greater than the expense, but the taxes are pretty high. Okay, so if you subtract this together, this with this, 17,000, 5,007, so it would be 17,339 plus 703 plus 5,450.0.08.12 is there, 0.12 here and 34 here. So if you add this thing and subtract this 12th earnings before taxation, 738. Okay, so this comes out to be in the loss side of it. Since the expenses are more, so it will come a loss. So that's why they have written loss for the year. In certain statements, it will just write net income and the figure would be negative. So negative means it's a loss. Okay, so other taxes. So the total loss of the year is 9,347, which has dramatically grew from 2019. So this is not a very good sign when we look at this income statement. So the next and the final statement that we'll be talking about is a cash flow statement. Now, cash flow statement tells us about the cash inflows and outflows of a company. So it is divided primarily into three types. Number one is the cash flow from its operational activities. That is the heart of the business, what they are working for, what is their business for, and all that stuff. So the second one is cash flows from investing activities. Now, investing activity means acquiring land, acquiring different entities in the company. All this thing comes under investment activities. Number third is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividend if they are earning really good profits. So it rolls out dividends for their shareholders so that they can share the profits of the company with them. The third one is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividends if they are earning really good, if their cash flows are really good. So they roll out dividends to share their profits with their shareholders. And also they could, financing activities would also mean that repayment of interest on different types of loan that the company has taken. Okay, now let's look at a cash flow statement. So here we have a cash flow statement of the same FMCG company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax on operations, that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, All this would vary from company to company, sector to sector, it would vary. So now we won't get into this, what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property, land, recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this stuff, financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. So this is minus, decrease, plus, 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 plus. This is minus. After this, we'll get a net amount of 61,759. Now, this is the cash that is generated from these operational activities. Now, they would incur certain taxes on it. So, after subtracting the taxes, we will get a net amount of 47,405. So, this was part A. I'll just mention that 47,405, or I'll mention in the next slide. So, the second part is, wait, first I'll mention 47. What was it? 405. Okay. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now the total net cash from investing is this 7,472. So we'll add 7,472 to it. Now cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case, all these things would be subtracted. So the net cash in financing activities would be negative. Okay, these all would be negative. Interest on liabilities, interest paid on lease, principal payment of liability, dividend, and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now, what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B. From operational investing I'll add, and financing I'll subtract 19,063. Now I will get the net value that is mentioned over here, 35,814. Now, what happens in this case is that it is rolled, there is a cash and cash equivalent at the beginning of every year. So, that is basically the end of previous year's cash flow statement's last entry, that is cash equivalent. So, as you can see, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So, this added with this year's cash equivalent, so this value here is posted here, because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay. So this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay. So these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. Okay. Next, we look into some of the accounting concepts that are a must to know when we start accounting. So the first one is separate entity concept. Now this states that the owner and the company are two different terms, they are two different entities. Now you would ask me, hey Madhur, we already know this, that a company and an owner are always different, so why do you want to make a module out of it? I'll tell you why. So when you start a company from scratch, let's say you are having a startup or you start your entrepreneurial journey, so it becomes really important to not mix yourself and business together. I'll show an example. Let's say that uh, I have a restaurant. So, okay, this I have a restaurant. Now, this is my personal self and this is my business self. Now, what does this mean? This means that if I have a restaurant, then I'll invest some of my personal stuff in the business. I'll give an initial capital. I'll give a capital to it. Let's say 60,000. Now that business with that 60,000 will purchase stuff like raw materials for cooking. It will get some staff. It will give employment. And let's say it then sells dishes to earn revenue, right? So in this case, let's say that the company is profitable. So it will get some profits that will go to the company C. Now these profits are owned by the company, but it is a property of me because I am the owner of it. So now this business will transfer its profit to me, right? So in this case, how a separate entity works. Now the profits will directly not go into my account. It will come to first the business account and then it will be transferred to my own personal account. Now what happens if the business has taken some loan, right? And my restaurant has some land in it that is owned by the business. Now let's say if my personal self and the business, they are not separate entities but are together as one. So now in this case, if by chance the business defaults on the loans, the collateral will be of the business and me together. Now, this can create an issue because then my personal assets will also get sold, which is a problem, right? So that is the reason why business should be separate. So the loans that will be issued are purely on the business land or for the business, not for my personal self. Therefore, it becomes essentially important to have two separate entities, one for my personal self and the second one for business, even if I own 100% of the business. The next accounting concept is going concern concept. Now, this is a very interesting concept which states that the company or the business entity should continue to run its operations for a very long time in future and also should not shut its operations midway. There can be certain reasons for that. For example, if the promoter of a company dies or a board of director resigns, the company should keep running its operations for a foreseeable future. This also states that the revenue of the company should only be charged for the things it utilizes. Let's say the company has taken a loan from a bank for 5 years. Now, in that 5 years, the company should utilize those funds to grow the company forward and should not let that fund be left unutilized. Another point in this concept is that the company should not liquidate itself. Now, what does liquidate mean? Now, liquidation means to shut down all the operations and selling off all the assets to repay any debt it has from banks or other entities. So, this concept makes an assumption that the company is reliable, consistent, and maintains continuity for a foreseeable future. This is also about being optimistic about the company, that its assets and resources will grow over time. So, all the business transactions and other long term third party contracts are held in a belief that the company will run its operations for a very long time. Let's take an example. So if the company, let's say, buys expensive machinery of 60,000 rupees, so and it assumes that the lifetime of that company is 6 years. So 6 years. This means that for all So this means that for all those 6 years, each year that company uses that machine's worth of 10,000. So the next type of accounting concept is called a double entry concept. So this is the most important type of concept in the accounting world. It has many other names, like it is also called as dual aspect concept, dual transaction as concept also. Okay, so for understanding this, first we need to understand what is a debit and credit. Okay, so let's say that you are buying a phone of 5,000 rupees. So 5,000 you will pay to the seller, right? 5,000. Now this amount is going out of your account to someone else's account, right? So this money is going away from you, right? Similarly, let's say a friend gave you 5,000 rupees as a gift. Okay. So this money is coming to you, right? So debit is something what goes out, credit is something what comes in the accounting terms, right? So now you understand. For example, you have also seen many messages when you withdraw money from your account, right? So the message comes that some XXX amount is debited from your account. Now this is what goes out of it. And if for example your salary comes to your account or something like that, or someone sends you money, then the message comes from the bank as this amount is credited to your account. So credit is what comes in, debit is what goes out. Now coming to the double entry concept. So this states that any transaction in the world has two aspects of it. One, what goes out, second, what comes in. So let's say that you are going to buy vegetables, right? So buying a vegetable, you would give cash. So cash would go out of you while the vegetables will come to you, right? So there are two aspects involved in it. So in the accounting terms, that entry will be made into two different accounts. One would be the vegetable account, the other would be the cash account. So the cash would deplete while the vegetable account would increase, right? So let's take another example. If you're buying a table or a camera or a phone, so in that case also, if when you are transacting a money to someone else, it is reducing your cash account. While you're getting something, a camera or anything, your camera account would increase. Right? What is this camera account or vegetable account I'm talking about? It is the asset account that you would increase, right? So there's one more thing, that double entry does not mean you make two entries in the same account. It is two entries but in two different accounts, and they are two different types. One is going out, the other one is coming in, right? So what is the benefit of it? It has four major benefits. First, it gives you a clarity of how the your business is performing, or also to maintain good accounting records. In an accounting world, the transaction is accurate when it is correct up to two decimal places. Thirdly, it would give a good holistic view of the company finances, how the company is doing, and it would reduce any bookkeeping errors if they occur, right? So these are the four key benefits of double entry concept. Next, we talk about matching concept. So in this concept, I'll explain you with the help of an example. Let's say that you are a retail seller and your business is of selling phones. Let's say that in order to sell phone, you purchase 20 phones. So I'll say by quantity and revenue. Okay. So let's say that you bought 20 phones for 10,000 rupees value. Okay, so your total buying cost is 2 lakhs, right? Now you sell that same phone for, let's say, 15,000, and you sell quantity is 10. So your net revenue is 1 lakh 50,000. Okay. Now seeing these two things, your buy price and selling price, you would say that, you know what, it is a 50,000 rupees loss, right? You would conclude that it is a 50,000 rupees loss. But is it so? Now, matching concept tells us that if you are looking at the revenue, then we need to first look at what is the cost incurred to gain that revenue, right? So in this case, we only sold 10 quantity of 15,000 value, right? So what would be the cost incurred for this 10 units? That would be 10 into 10,000, since we bought it for 10,000 rupees. So the total cost for that 10 phones would be 1 lakh rupees, right? Now, if I subtract that 1 lakh from the selling price of 15,000, I will get a net 50,000, and that would be my profit, right? This would be my profit. Therefore, the concept of matching defines and states while preparing an income statement, so the revenue is corresponding to the relevant expenses. We cannot change the quantity of different things and then say that, okay, the revenue is deferred or it is a profit or a loss. We cannot conclude until and unless we have seen the cost in which it is made, right? So this was matching concept. So now, after learning about all the basic terms and terminologies like asset, revenue, bookkeeping, receipts, invoices, also after getting to know about the different accounting concepts, now we are in the position in which we can actually know how the accounting cycle works and what are the various steps that are involved in it. Okay, so let's look at the accounting cycle. So it has primarily 7 steps. So let's look at each one of them. So the first step of the accounting cycle is the collection of various transactions. Now, this is our first step. Now, we already know how we track these transactions. It is through receipts, bills, invoices, and so on. So, in the same way, we will know each one of them by their bills. So, we will collect all of those transactions. We'll collect the invoices, the bills, the receipts that have been generated that are kept with us. So, we'll all collect that and store in one place. Now, the second step of this accounting cycle is to record into a journal. So we need to make a journal entry. So I'll tell you what a journal is. So journal is basically a book in which you note down what are the transactions that are happening. I'll show you the example of how a journal looks. So in accounting, this is how a journal looks. So it has a journal number over here. That is the starting. So this journal number is unique. Now this tells you that various types of journals that are present. So this would give you a look at what it is. Now, the first step is to writing the date. Now, this is important because it will tell you at what date that particular transaction happened, the posting date of it. So that we'll mention it over here. Then second column comes the account. Now, there are a lot of different types of account in accounting, like the cash account, the cost of goods sold account, the inventory account, the receivables account. So all these are different types of account. Now, the third and the fourth columns are debit and credit. Now, as you have learned in one of the accounting concepts, the double entry concept, in which every entry has to be made into two different accounts, right? So here in this case, our first account is cash and the second account is inventory. Okay, so now these two things are mentioned over here, but you can see that there's a little gap in between, right? This is to differentiate between what are debit entries and credit entries. Now in this, in cash account, the money is debited, so it is written as debit. In the inventory account, the money is credited, so it is in the credit side of it. Okay, so that is why all the credit entries to have some space from the start. So that is why this gap has to be maintained. And this is one entry, right? So there can be n number of entries down here of various accounts. Okay, the most important part of it is that the total debit here should be equal to the total credit. Okay, so that is very important in a journal entry, that all the debit side and the credit side should match. Okay, so the next phase after journal entry comes maintaining a journal ledger. So the journal ledgers are basically the accounts, the combination of various journal entries into one single book, right? That is called as a journal ledger. Now, the difference is that earlier times we did not have a modernized journal ledger. It used to be most of the times something called as T accounts. So T accounts would look something like this. On the left side would be debit, on the right side would be credit. Okay. So these were made for all the different types of accounts. Like let's say there's a cash account, there is a accounts payable, right? So these T accounts were made for every single type of account, and those were to be clubbed together to make a one general ledger, right? These were known as subledgers. Subledgers. Okay. So on the left side is debit, on the right side is credit. For example, you would have to give, you are liable to pay 3,000, let's say $4,000, right? So you will debit $4,000 from the cash account and you will credit the same into the accounts payable section of 4,000. Okay. So then there would be one book that would combine the two into recording things, right? That is known as a journal ledger. That's all. Next is trial balance. Now, trial balance is a document that is required to be made to ensure there are no errors involved in the accounting process. Now, the errors could be you may skip an entry, you may skip a transaction in one of your accounts, or you may replace the debit side entry to a credit side entry. Or even you can make two entries of the same transaction in one single account. So all these mistakes have to be taken care of when we are dealing with a large scale business, right? In which multiple transactions happen every single minute. So this is why it becomes important to proofread everything, right? So let's see how a trial balance look. So a trial balance can be posted on any given time in an accounting period, right? So for a trial balance, first we need to know the end date, which date it is posted. So that would be the top heading of a trial balance. Then we have three columns. The first one is the accounts. So which type of accounts are utilized in the transactions? So these are mentioned in the first column. The second column is the debit side and the third column is the credit side. So all the transactions happening would be taken care of in this. So different accounts would have different entries that need to be put. So in a typical layout of a trial balance, so the first entries, the first accounts are mostly assets. Then comes the liability side of it. Then comes the owner's equity, revenue, and expenses. So this is a general layout of how a trial balance is. First comes the asset, then liability, equity, revenue, and expenses. So this is the way. Similarly, like a journal entry, in this also, you have to make sure the total debits is equal to the total credits, right? So everything needs to be in the perfect order. The equation should satisfy debit equal to credit. Okay, so after covering all the four steps, we come to the fifth step, that is adjusting entries. Now, let me explain you how it is with an example. In India, the financial year is considered to be from 1st April to 31st of March. 1st April of, let's say, 2020, 31st March of 2021. Now, there can be some situations in which some of the payments are done in between of these accounting cycles. So, for example, one of the purchases is done on 30th of March, right? So now it becomes complicated to know where to put these transactions, either in the previous accounting cycle or the new accounting cycle, right? So this happens in mainly two cases. The first one is known as prepayments. So the good you haven't received it yet, or the one that you have not purchased yet, but the payment is done, right? So it is called prepayments. And the second would be a deferred revenue. So now these things have to be taken care of, where to put these payments or where to put the deferred revenue. So all these calculations are involved in the adjusting entries that a company does. Next is preparing financial statement. So we have already discussed the three main financial statement, that is the balance sheet, income statement, and cash flow statements. So after this process, all the data that we get, all the numbers that we get are then aligned together to make three financial statements, right? After preparing these financial statements, and the last step of the financial accounting cycle comes closing entries. Now, what are these closing entries? So after finishing all the processes, be it journal entries, be it posting in a ledger account, be it checking if the debits is equal to the credits or adjusting those entries and making all the financial statements, in this step, all the temporary accounts, be it ledger accounts or be it journal entries, everything is set to zero for the next accounting cycle, and all the things that are left over are sent to the owner's equity, because at the end they are our major stakeholders in the company. So everything, be it profit or loss, is transferred to the permanent accounts of owner's equity. So this happens in an accounting cycle. Now let's look at what we learned in this course. So we started by knowing what is accounting, what are the different types of accounting. Then we moved on to knowing what does bookkeeping means in accounting, what is the importance of bookkeeping. Then we talked about the phases of bookkeeping process. First is creating a record keeping system. Second is tracking those transactions, right? So that we learned. The third part, reporting these transactions. We learned to make three of the most important financial statements called the income statement, balance sheet, and cash flow statements. After that, we looked at some of the most important accounting concepts that are a must to know when it comes to accounting. After that, we had a step-by-step analysis of different steps involved in an accounting cycle. I hope you had a great time learning about these concepts, getting a whole in-depth view of what exactly accounting is. Stay tuned to get more of these courses by Great Learning. If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of Great Learning. And of course, if you enjoy this video, show us some love. Do like the video. Knowledge increases by sharing, so make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions, and I would be more than happy to respond to all of your comments.